this video, we are going to talk about how you can apply for a credit card without murdering your credit score. If you or someone you know wants to get a new credit card so that they can improve their credit limits and their credit utilization ratio, but is afraid that applying for a new card will instead hurt their score, then you've come to the right place. By the end of this video, you'll know how you can achieve that goal without negatively impacting your credit score one bit. Welcome back, Money Masters. It's another Finance Friday, where we are flipping the switch on credit and debt to shed some healthy light on how you can safely use other people's money to achieve your dreams. As we mentioned earlier, today we are going to be talking about how you can apply for a credit card without murdering your credit score, which will help you know how you can achieve that goal without negatively impacting your score one bit. But before we dive in, I just want to let you know that on Saturday, we will be discussing the E-Myth Revisited by author Michael Gerber. So if you don't want to risk missing out on that episode, make sure to subscribe to our channel and hit the bell icon so that you can be notified of our next amazing video. Okay, with all that said, if you are just like us and you are totally committed to obtaining financial independence, then go ahead and tap that like button and let's get into it. What your credit score is and the factors affecting it. Before we get into the meat of our video, we should talk about your credit score so that you're informed about it, understand why it is so important, and how it can be increased or decreased depending on your credit history. To put it simply, your credit score is a number that typically ranges from 300 to 850, which represents how trustworthy you are and is a metric that companies, issuers, and lenders use to gauge whether it is worth it to lend you money or open up a line of credit for you. To them, a higher credit score means that you are more likely to repay debts or loans on time. This will have a huge effect on the chances of your approval. Next, let us talk about how those scores are calculated through the FICO scoring system. There are many different scoring systems used by different people, but the FICO system is by far the most commonly used one, so we are going to break that down for you right here. As you can see, the weight of each criterion is as follows. The payment history counts for the largest portion of your credit score, totaling 35% of your score. When your payment history shows that you are good at consistently paying your debts, then that is a good thing for you. The second largest factor accounting for 30% of your credit score is your credit utilization ratio, which is the ratio of debt you are carrying to the maximum limit your credit lines can have. You should make sure that your credit utilization stays above 0%, but ideally will not go higher than, say, 30% of your total credit limit. Keep in mind that not taking on debt at all is going to negatively affect your credit score, while taking on too much debt is going to do the same. Next, we have the length of your credit history, which makes up 15% of your score. Longer credit histories tend to be better because that means more data for your lenders and issuers to determine your payment history. Next, we have the variety of credit lines and accounts that you have. Banks and lenders tend to prefer people who have a history of carrying a mix of several types of debts because it shows that you are financially responsible even across distinct types of debt. This is not as much of a factor given that it makes up 10% of your score, but it does help to diversify your credit accounts anyway. The last factor, new account, accounts for the last 10% of your credit score. The idea behind this is that the higher the number of new accounts that you open up within a brief period, say a month, the lower the average length of history in your credit account is going to be. So that should be considered when trying to open a new line of credit. How credit card applications affect your credit score. Another thing to look out for when opening new accounts is the number of inquiries that applications for new accounts and lines of credit bring about. Here is how that works. According to Bankrate and Credit Karma, if you've applied for any kind of financing or credit, chances are that your lender will look into your credit history, also called pulling your credit history, to decide the terms and whether they're even going to push through with your deal in the first place. All this investigation is being done so that they can assess whether you're going to be a financial risk should they lend you the money you requested. Now, these types of inquiries into your history are what we call hard credit inquiries, or hard pulls, and they all have the potential to decrease your credit score. These types of inquiries are done whenever you decide to take on a major monetary responsibility like a loan or apartment rental application, or even when you apply for credit cards. You will also have to authorize the lender or card issuer to pull your records, and this inquiry will stay on your credit reports for 2 years at most. Now, there are also other types of inquiries called soft credit inquiries or soft pulls, which are the same as background checks and should not affect your credit score all that much, if at all. One way you can minimize the damage any hard credit pulls do to your credit score is to actively monitor the credit reports, which counts as a soft pull and should not affect your credit score. Granted, a single hard credit pull is not going to affect your credit score all that much. However, when you apply for several credit cards or loans within a brief period, it is going to look on record as if you're running low on money and preparing to take on a lot of debt, which is going to affect your credit score. So hopefully, you are starting to get the picture when we say that the timing of your applications matters. What factors have you had the most difficulty with? Be sure to let us know in the comments down below. How your income affects your chances. Aside from your credit score and the credit factors, your income is also a big player that affects the odds of your approval. To put it simply, when you have a higher income, you are going to have a higher credit line, and the lower your income is, the lower the credit lines you will be offered. When you have a higher income enough to cover your living expenses and still have some money left over, banks and issuers will see you as less of a risk and will give you better lines of credit as a result. They still need to make a profit. As an example, let us take a look at two cases with identical credit scores of 700 but different credit factors. Our first case has a total debt of $8,000 out of their $10,000 credit limit, reaching a credit utilization of 80%, whereas the second case has a credit utilization of 25% instead, with a debt of $1,250 out of this $5,000 credit limit. Both applicants have a high credit score, but because of their current credit factors, only the applicant with a 25% credit utilization gets his application accepted. This shows that banks can and will look past your credit score, so it is better to work on all of these factors to make sure you have the best chances you could have to get your application approved. Finding the right balance. So, given that you have to worry about your credit score, credit factors, and income, as well as the frequency of your credit card applications, we think that the best general plan for getting a credit card without taking a hit to your credit score is this. For the first year, you should focus on getting only 1 to 2 cards, even secured credit cards if you are only starting to build your credit score. You should apply for these cards a few months apart so that you can minimize the negative effect of both new accounts and younger credit history. The thing you're going to be focusing on for this first year is to get used to these credit cards and build your credit score through them. This will not only increase your credit score and help you get better loans and interest rates, but it will help your chances of getting new lines of credit, as well as allow you to take a few more hits to your credit score than you could in your first year. This means you can apply more frequently without murdering your credit score. For the second year and all the years beyond that, you can then try to apply for a credit card every 3 months. This should allow you to manage the hits to your credit score more effectively while also enjoying the benefits and rewards of having a higher total credit limit. Now, this is our suggested plan that should work for most people, but it is always a good idea to study the rules and policies of the banks and issuers that you are going to be applying for a card at. What are your thoughts on our suggested plan? Do you have a suggestion for a plan of your own? If you do, don't be afraid to share it in the comments below. So that's all we have for you today. We hope you learned some very helpful insights from what we've shared with you today. Please don't forget to leave a like on our video if it was able to help inform and positively influence your financial decisions and lifestyle, and leave a comment down below about how you feel like this video will help you boost your overall income. Also, if you love our content, subscribe for more Money Masters content and updates, and so that you don't miss out on our next episode of Finance Friday, where we will be discussing how you can apply for credit cards without endangering your credit score. Also, we'd like you to consider sharing this video with at least one friend. It would mean the world to us if you would join us in our mission of helping good people like you keep more of what they earn and earn more from what you keep. That'll be all from us in this video, Money Masters. We'll see you in the next video.